Okay, I guess this is a brinkmanship here, and everything will be sorted out right at the last minute. Yeah, that's what you're suggesting.
Well, this has been going on for how many years now?
I know we've been talking about it off and on now for, I think, since 2011.
Yes, this has been going on for 4 or 5 years now, and I suspect that something will materialize last minute. I don't see the Greece leaving the Eurozone at all.
There seems to be two stories. Greece, okay, what's happening there, causing concern, but really the fundamentals of Europe's recovery seems quite good.
Yeah, Europe has been recovering somewhat because of QE. We've seen in America as well in the last few years, whenever the Fed embarked on the QE initiative, we saw long-term interest rates go up, a pickup in inflationary expectations and a mild pickup in business activity, and certainly an improvement in sentiment. And this is exactly what is happening now within the Eurozone. Don't forget the euro itself has fallen significantly over the last 18 months or so. So we are now seeing some of the benefits of the cheaper currency as far as the exporters are concerned. And we suspect that the sluggish recovery will continue for as long as Mr. Draghi continues to buy bonds.
Well, that's the thing, isn't it, about bond buying? It inflates assets. This is what happens. But, I mean, are they artificially inflated? That's the point.
Well, it certainly pushes down long-term government bonds. You know, before the launch of the ECB's QE initiative, Rishaad, bonds were very, very high. Long-term interest rates were extremely low in most of the developed countries.
But has this route got ahead of itself now?
Well, I don't think so. I think this bond route will continue for as long as Mr. Draghi is buying bonds. You know, if you see what happens when the Fed was buying bonds, when we had QE1, QE2, and then the latest bout of the long QE, long-term interest rates kept going up and up, and then they fell just before the end of the QE program. So I think something similar will take place now. I wouldn't be surprised if long-term yields continue to go higher for several months, and then they peak perhaps during spring or summer next year, just before the end of this launch of QE by the ECB.
Okay, let's say what you expect doesn't happen. Let's say they don't have a deal. Let's say there is a Grexit. Can all of this good work that ECB has done, the recovery and all the rest, be completely for naught?
Well, we will have a serious turmoil in the markets. There's no question about it. You know, the euro will probably go down. You're going to have turmoil in the financial markets.
Won't the euro go up because of the Greeks leaving, if that should happen?
I believe if there is turmoil in the Eurozone, money will flow to the world's reserve currency, the senior currency, which is the dollar. So I think the dollar will benefit during a crisis. This is what we saw in the global financial crisis. Whenever there is turmoil anywhere in the world, capital seems to go to the world's reserve currency. So I think the euro will weaken. You're going to have some setbacks in the financial markets. The stock markets are going to go down, and precious metals may have a bump up. You know, you will get turmoil and volatility in the near term, but I just think that the chances of that happening are very remote.
Right, so where do we go from here? I mean, with Europe in mind, we've got also data from the US improving. That retail sales number showed that the American consumer is seemingly putting his and her hands in their pockets and spending some of that cash.
Well, things are improving. We've said for a while now that the developed world is improving, is healing. The housing market in America is certainly on the way up. It bottomed out in 2012. And as asset prices have appreciated, people are feeling more euphoric and willing to spend a bit more. There is no coincidence there. Even the credit growth has picked up. You know, we had several quarters of credit contraction at the consumer level in the US. Debt growth has also picked up finally. So the QE initiative in America has worked. You know, we have avoided a big depression in the United States, and things are on the way up. And I think asset markets in America are reflecting that, and the stock market, in my view, will continue to head higher for another couple of years.
Okay, so if you had to choose either or, okay, hypothetically, Europe or US?
Well, I would... If I had to choose one,
Only one.
Well, if you put me on a tight spot and if you talk about capital appreciation over the next 12 to 18 months, I suspect that European stocks will probably outperform American ones. By and large, I'm talking about the overall indices here, simply because QE is now going on in the Eurozone, not in America, and we have seen that...
Inflating assets
and
again.
QE inflates assets in the region. We've seen that with America, we've seen that with Japan, now we are seeing that with the Eurozone. We've seen what the Chinese stock market has done with the easing. So monetary easing trumps everything else when it comes to investing. So I would pick Europe over the next 12 to 18 months.
But ultimately, you think it's a false paradigm, or supporting real fundamentals here?
Well, fundamentals are improving. You know, you're not going to get a blistering economic recovery simply because the debt overhang is simply too large at so many levels. But as long as the Eurozone avoids a recession, and things gradually heal, and you have maybe 1 or 2% GDP growth, I think that's sufficient to push up asset prices, because asset prices in Europe have done nothing for so long, and we've just come out of a lengthy crisis, and history has shown that whenever you come out of a world-class crisis, you get a world-class rally afterwards. So I think we're in the stage of the world-class rally.